Student loans are a big business. The US has amassed over $1.7 trillion in outstanding student debt. Until recently, it was the largest non-housing debt for more than a decade.
The first time it broke $1 trillion was back in 2012, and that's when it caught all the media attention.
We've seen a big growth in the cost of education over the past 10 or 20 years, and this has really showed up in the student loans outstanding.
But while more than 43 million Americans are currently holding student debt, many are unaware of what exactly happens with their loans.
I think it would be pretty difficult for the average American to try to track where their loan actually resides.
There exists a market where billions of dollars worth of student loans are packaged and sold as assets known as SLABS to some of the biggest investors in America.
I would say that most average Americans are not aware of student loan securitizations.
These securities are very, I would say, not transparent, and it's hard to understanding by average investor.
So what exactly are SLABS? And how does it help Wall Street profit from student loans? Securitization is the practice of converting assets, usually loans, into securities that can be bought and sold by investors. Wall Street uses securities to trade almost everything you can think of: auto loans, business loans, and even aircraft leases.
Let's say I'm a bank and I want to issue a bunch of loans. After those loans are issued, I can then sell them to a third party in order to securitize them. Now, just because I sold them doesn't mean that I do not get to account for the estimated value of those securities. I've just sold their interest to a third party. So it's a very lucrative arrangement for a corporation. It's a very lucrative arrangement for the investors.
The biggest and the most well-known type of asset-backed securities are mortgage-backed securities, or MBS. There were more than $12 trillion worth of outstanding mortgage-backed securities by the end of 2021.
Securitization, its history really started off with the mortgage market. And the mortgage market is a much larger market than other forms of consumer credit, especially other forms of financing of consumer credit. So that lends itself to being a much larger market.
Student loan asset-backed securities, or SLABS, refer to securities that are specifically built around student loans.
The way that borrowers get student loans is of two ways. If they're getting a federal student loan, they usually apply using FAFSA, right? If they're going to get a private student loan or a private credit student loan, they would apply through a bank or through a lender. The loans that are then created are bundled together into a pool. And these pools are often highly diversified by regions, by school, by borrower type, for example. And the diversification really protects the investor from losses that are idiosyncratic. They're then transferred to a special purpose trust, which is set up to hold the loans and issue the securities. Once that's done, the securities are then rated by a credit rating agency. Once they're packaged in this way, the securities are then sold to financially sophisticated institutional investors. When the borrower pays down their student loan, that cash flow is then used to pay down the investor.
Sallie Mae and Navient are the two largest publicly traded companies issuing SLABS. These assets are underwritten by some of the biggest banks and corporations, like Bank of America, Barclays, JP Morgan, and Goldman Sachs. $92 billion worth of student loans were issued as SLABS within the past 5 years.
There are two types of securitized student loans. So you have private student loans and you also have federal student loans that have been securitized.
A majority of SLABS today, 56% to be exact, are based on loans that were made before 2010 under the Federal Family Education Loan Program, also known as FFELP. These loans were enticing for many investors because they came with a federal guarantee that protected them against losses from defaults.
For about a decade, FFELP securitizations, or FFELP ABS, were the only form of student loan securitizations. It's a program where a private lender originates the loan based on the guidelines that have been put forth by FFELP. As long as those guidelines are met, the loans are guaranteed by the government, and that guarantee runs between either 97 to 100% of the loan balance.
But shares of private loans have grown with the recent boom in the private student loan market. The industry is estimated to have grown by more than 70% over the past decade.
Based on my research across the board with student loans, the biggest sense of security outside of the federal guarantee is the question of whether these loans are dischargeable in bankruptcy.
While it is certainly possible, current bankruptcy laws make it extremely difficult for student loans to get discharged, compared to other types of debt. For investors, that translates to a lesser risk of default.
The securitization of mortgages, all student loan or auto loan, actually has a very positive motivation at the beginning. And that is to mobilize the capital around the world and channel that to the most needed. You are no longer being restricted to your local bank or a specific lender. It's just the whole liquidity enhancement around the world. So that itself is a pretty good idea, but Wall Street sometimes can go a little bit too far.